Greetings, everyone. Welcome to Cutting Through the Noise. I'm Samantha Geyer, Marketing and Communications Manager here at SignatureFD, and I'll be today's moderator. Before we dive into the presentation, let me tell you a little bit about Tony and our firm. Tony is a partner and Chief Investment Officer at SignatureFD. He chairs our investment committee and represents the firm at various industry events. Tony is a contributor on numerous broadcasts, including NASDAQ Trade Talks and TD Ameritrade Network, and his commentary has also been featured in articles from the Wall Street Journal, Barron's, the Financial Times, the Bond Buyer, CNN Business, and other prominent industry publications. SignatureFD is a financial advising firm headquartered in Atlanta, Georgia. We believe in helping our clients achieve wealth beyond money. We empower our clients to use all elements of their wealth to create a financial design that helps them grow, protect, give, and live their wealth to the fullest. It's what we call net worthwhile. With that, I'll turn it over to Tony to get us started.
Thank you for that, Samantha. And thanks to all of you for joining us today. This episode will hopefully be pretty succinct, but I think it will get across some of our key views. So for today's agenda, what we're going to start with is the sentiment backdrop. So investors entered the year on a high following the year-end rally, and optimistic sentiment conditions have traditionally led to subpar returns from there. Also, there are some seasonal trends at play that present a bit of a headwind in the near term. After that, we're going to shift our focus to the economic data, which has been good. Unfortunately, good data may be treated badly by markets because it doesn't really support Fed rate cuts. Because of that, we may be entering a period where good news is sort of bad news for the market and vice versa. But we want to be sure to remember that over the long term, good news is in fact good news. Now, our expectation is that the bull market will continue into this year, and we're interested in some areas like small caps that lagged last year. So we'll talk about that as well. So let's start with market sentiment. Now, in orange in this chart, we're showing a survey of individual investors where they're asked their opinion on the direction for stocks over the next 6 months. Now, heading into the year, most of them responded that they expected stocks to be higher by the summer. Now, the mood of investors has historically been a contrarian indicator. So it would not be abnormal to see some market consolidation in the upcoming months, starting from a place of optimistic sentiment. Now, election year seasonality is also something of a headwind in the near term. So here we're showing the pattern for the average election year in history. Now, we can see that they tend to be flat to down in the first 5 months or so of the year before rebounding through those summer months. Also note that election years do tend to be higher by the time all the dust settles, but the gains do tend to be weaker than the pre-election years. As a reminder, 2023 was one of those pre-election years. Now, if we turn to the economy, there's a lot of discussion around a so-called soft landing, or is it going to be a hard landing, i.e. a recession? Now, first, I'd love to see the plane metaphors just retired this year, but as long as we're using them, so far, the data is actually somewhat consistent with no landing at all. So here I'm showing some key retail sales data. If you pull out gasoline, which is volatile and was down in the last update, you had retail sales growing at 5.1% year over year. Now, retail sales growth has actually accelerated somewhat recently. We're seeing other indicators of consumer spending and sentiment accelerating as well. And consistent with a plane that's not ready to land yet, inflation in the key services category is still pretty high. So in fact, service inflation, where we strip out energy and rents, that's still 3.9% year over year. And that's the dashed black line here. Now, it's much lower than it was, especially in 2022, but probably higher than the Fed would like to see. And that's because demand is probably still running a little bit hot. Now, we would put about a 20% probability that the economy stays hot this year and we get this sort of no landing scenario. And we'll talk about what these different scenarios could mean for stocks here in a minute. But first, let's talk about our highest probability outcome for the next 9 to 12 months. And that is that the economy is likely to slow, demand is likely to cool, and inflation will continue to moderate. So let's start with the economic trajectory. So here in blue, I'm showing the economy. In orange, we're showing a model that's comprised of 27 different indicators that gives us a holistic view of the health of the economy. Now note that those indicators are not net positive, and they're only consistent with an economy that's kind of in a slow growth mode. Certainly not consistent with an economy that's likely to overheat. Now, Ned Davis Research has a similar model for inflation. So here in blue, we're showing the rate of overall inflation. In orange, we're showing a model comprised of 21 different indicators that are meant to describe the inflation environment. And we can see that the weight of the evidence, that suggests that inflation pressure will continue to cool. Now, it might not be as fast as the improvement that we saw last year, but it's likely to be improvement nonetheless. So let's spend a little bit of time on what this might mean for investors. Now, in this chart in blue, we're showing the S&P 500 index. In orange, we're showing economic trends, and the dashed black line is inflation. Now, we can dice things up into 5 specific scenarios. Let's blow this box that's in the chart here. Let's blow this up, and we'll walk through it. Now, the mix of the economy and inflation can be overheating, or it can be strong growth with low inflation. It can be slow growth with low inflation, stagflation, which is negative growth but high inflation, and recession, which is negative growth and weak inflation. Now, in 2023, we were here. We got strong growth and we got inflation that was falling relative to where it was in 2022. And now, historically, that has been a zone that has been consistent with the strongest market returns. And last year certainly disappointed. Now, we think we're headed here, this box that we've circled here that shows slow growth, low inflation. Now, that's not necessarily a bad environment for stocks. Stocks have actually had pretty strong returns in a slow growth, low inflation environment. It's just downshifted from the very strong returns that we might have seen in 2023. Now, another reason to expect a slowdown in the market's uptrend is that we reached new all-time highs recently. Now, the stock market can really only be doing 3 things. Again, let's blow up this box and talk about it. The market can either be at an all-time high, and thus it's creating new wealth. It can be recovering from a prior bear market, or it can actually be in a bear market. Now, note, we've circled here that the strongest rate of return has, in fact, occurred when the market's recovering from a prior bear market. And again, that's what we experienced in 2023. But when the market's making new wealth, the rate of return has almost been cut in half. So note that new highs certainly aren't a reason to be bearish. That's not a bearish development. But we need to temper our expectations that the returns would continue to be nearly as strong as last year. Now, a final broad point that we make is around valuation and earnings. Stock prices tend to lead fundamentals. We need to remember that. The fundamentals don't lead prices, prices lead fundamentals. And it's not uncommon for valuations to get more expensive in the first year of a bull market. But after that first year, we should start to see improvement in corporate earnings. So here in this chart, in the middle in black, we're showing the average pattern for the S&P 500 index, and that's our representation of stock prices. And that's the vertical dashed line. Now, historically, the market rallies strongly in the first year and then settles into a bit slower of a trajectory. But corporate earnings, which we're showing in red in the bottom, they don't really tend to improve until the bull market is 8 to 12 months old. Because of that, valuations tend to get more expensive in the first year of a bull market. Now in blue, that's what we're showing. We're showing the average price to earnings ratio around these same bear markets. Now note how stocks get more expensive, but then as earnings start to come through and the market gains slow down a little bit, valuations do tend to improve even without a bear market. And that's what we think could happen this year. So getting a little more granular, let's talk about a couple market segments. If we look at the leaders from last year, they're trading at pretty rich valuations. And what that means to us is that they're going to have to come through on some pretty meaningful growth this year in order to justify their valuations that ran up last year. So here in this chart, we're showing the price to earnings ratio in orange and the price to sales ratio price to earnings is in blue and price to sales ratio is in orange. For the elite 8 stocks, which are comprised of 8 mega cap tech related companies. Now, these are incredible companies, but they trade at 38 times earnings and 7 times sales. Now, I wouldn't call these bubble valuations, and these stocks could very well have another good year this year, but I also wouldn't call them cheap. Now, we own these companies in a reasonable proportion. We're neither overweight or underweight them. But what does look cheap to us from a valuation perspective are small cap stocks. Small caps underperformed last year as they were more negatively impacted by higher interest rates and higher labor costs. But here in black, we're showing that small caps trade at 14.6 times earnings. Those mega cap growth stocks from the slide before are almost 3 times more expensive than that. Valuation is a terrible timing tool. So what could be the catalyst for small caps this year? Well, we think we could see a turnaround in small cap earnings trends. So here in blue, we're showing earnings growth for small cap growth companies. And in red, we're showing earnings growth for small cap value companies. Note that earnings contracted 17% and 32% respectively. But if we're correct that the economy will remain in expansion mode and inflation pressures, especially labor costs, are going to ease this year, then small cap earnings should improve quite a bit in 2024. And that could be the catalyst that we need for small cap stock prices this year. So let's recap what we went over today. We expect the market to enter a period of consolidation consistent with a high level of optimism and election year seasonal trends. We may not make that much headway in the next few months. And optimism about lower interest rates is probably misplaced for now because the economy is still strong and inflation is still higher than the Fed wants to see. We do expect the economy to slow down and inflation as well. That would be consistent with our indicators that we showed throughout this presentation. A slower uptrend would be something that would be consistent with a market at all-time highs and a mix of softer growth but softer inflation. Now, the big winners of this past year and really this cycle have been mega cap growth stocks, but they do look pretty richly valued. Small cap stocks are an area that appears cheaply valued with a potential for positive surprise. So that's what we have prepared for today. As always, if you have any questions, feel free to email myself at tony.welch@signaturefd.com, and we'll be sure to get back to you. Thanks for joining us.